450.
Let me finish up with Mark, and then we can come back to this news. Mark, I just want to understand, because you could be scaring the viewers, including myself. When you say that there's a downside, how big a downside? Put a number on it.
Well, I mean, I would say that well-to-do people may lose up to 50% of their total wealth. They'll still be well-to-do. Instead of $1 billion, they'll have, say, 500 million. But I think there is a massive wealth destruction coming down the line. I'm not saying it will happen tomorrow, but I think looking at the bailouts and the money printing, they basically have postponed the problems and actually made them larger, in the sense that the government debt has increased dramatically, and somewhere a solution will have to be found for this government debt.
So, Mark, we have Sally Krawcheck on the set, and Sally, if you heard Mark this morning, or rather, if your clients were watching this morning and they heard Mark, and then they called you and they said, "Sally, what do I do?" What do you do about a prognosis like this?
Well, I think, Mark, isn't the answer you hold more gold? I wish this were real gold. Isn't it? Is it you're holding on to stores of significant value, right?
Well, I think in my report, I also pointed out there is one asset class that is relatively depressed, and these are properties in the south of the United States, say in Georgia, in Arizona, in Florida, and so forth. I think their property values will not collapse much more and will stabilize. And so I think to own some land and some properties, not necessarily in the financial centers, but in secondary cities, is a desirable investment, relatively speaking.
So I'm looking
at... Then I think that people should own some gold, and I think that people should own some equities, because before the collapse will happen, with Mr. Bernanke at the Fed, they're going to print money, and print and print and print. And so what you can get is a bad economy, but rising equity prices.
Mark, thank you for depressing us this morning. We appreciate you being with us.
No, it's not my intention to depress you, but I think we have to think realistically that the debt contraction basically has been postponed, but the huge debt is still there and still growing. You look at, say, student loans. I don't believe that all the student loans will be repaid ever.
Mark, we're going to have to run, but what is the tipping point, just so I understand? I know you're calling this as sort of a decade, that you expect this will happen in the next decade, but what do you imagine would be the tipping point? What is going to set off that hyperinflation that you expect? Well,
I'm not necessarily saying hyperinflation will occur, but I think that we can have first inflation in asset prices, as we had in the last 20, 30 years, and then that asset prices will come down, like the real estate market came down in the United States for residential homes. And what will be the trigger? You never know for sure. I mean, I didn't know that the NASDAQ would peak out on March 21st, 2000, and then collapse by 70%.
Right.
But I knew that it would happen.
Okay. Mark, thanks for joining us.
It could have happened from a higher level or from a lower level.
Right.
That is the difficulty, and I always tell investors, the problem, and fund managers, the problem is if you go 100% into cash,
right,
and you have money printing and asset prices continue to go up, you may lose all your clients, or you may lose the purchasing power of your money, because we have negative real interest rates.
Mark, I want to say thank you for, listening to you makes me nervous, so it's a good way to start the morning.
Well, I think you should be nervous. I think that
okay.
is...
We got to run, Mark.